Hello and welcome to Compounding Curiosity. I'm your host Kalani Scarrett, and this podcast is all about compounding your curiosity alongside my own through thoughtful interviews with interesting guests. For transcripts and detailed show notes, check out the links in the description. Hopefully you're as keen as me to learn something new, so let's get stuck in. My guest today is Stephen Clapham. Steve is a former partner of the Tiger Cub and former head of research at another multi-billion-dollar hedge fund. Nowadays, he is the founder of Behind the Balance Sheet, where he produces investment research and offers training services. Steve is also the author of the book The Smart Money Method: How to Pick Stocks Like a Hedge Fund Pro. In this conversation, we cover red flags for fraud, some accounting standards, and his new podcast. So please enjoy my conversation with Stephen Clapham. Stephen, thanks for being on today. I really appreciate it. But I don't know, we'll start pretty broad and then we'll dive down into the details. But I think maybe a good place to start is, where do you start when analysing a company's financial accounts? Like, what's your process? And maybe just walk through start to finish, and then we'll go on from there.
You know, I start at the back. I look at the contingencies note, I look at the related parties note, I look at the audit report. And then I go through the balance sheet. You know, most people open their accounts to look at the P&L. I mean, you know, I'm not saying that's not a bad idea. I mean, usually by the time I've got to the accounts, I'm already familiar with the P&L. You know, the reason that I'm looking at the accounts is because I've detected an opportunity for under or overvaluation, and I therefore have some clue about the company's earnings. So what I'm trying to do when I first open the accounts is get a sense of whether there's a risk that the accounts are crooked or not. And when I say get a sense of the risk, whether they're crooked, most of the accounts that I look at are crooked. It's a question of how crooked they are.
So how do you judge how crooked they are, I guess? Like, is there any easy red flags to look out for? Like, and maybe how do you view qualitative versus quantitative red flags?
Well, I've got a whole load of videos on my YouTube channel, which is, you know, Behind the Balance Sheet. And I go through, I think, 7, 8, 9, I've forgotten how many accounting red flags. But the three key flags for me are, first one I look at is the margins. So if the margins are higher than the peer group, then I ask myself, why is that? And, you know, I have a forensic accounting course that I do for institutional investors. In actual fact, I've had a lot of demand from private investors, and so I'm thinking about doing like a multi-person Zoom where, you know, I'll get, 20, 30, 40 people on to do that course. But I primarily do it for large institutional investors, both here in the UK and in the United States. And in fact, I've actually done it for institutions in Brazil and Middle East. I mean, loads of people. So, I mean, several hundred people have taken that course. And when I was building that course, I spent 6 to 8 weeks in the British Library. The British Library is a huge building, and it's got every book ever published. I say it's got every book ever published. There's one investing book which is valued about $3,000 that somebody's nicked it. But and so I spent a lot of time, much more time than I'd originally budgeted when I was doing this, because I got very curious about it, and I looked at every past fraud I could find. And the one thing that stood out about most of the frauds, not all, I mean, you know, there's never a rule that will fit 100%, but the vast majority of frauds had margins that were odd. Not everyone. I guess, you know, you look recently, maybe Wirecard didn't have exceptionally stupid margins, but most frauds, the margins are out of context. So my first check is look at the margins. My second check is to ask myself, are the earnings turning into cash? And if you've got earnings that aren't turning into cash, there's usually something wrong. It may not be a fraud. I mean, these checks are useful because if you've got earnings that aren't turning into cash, then it may just be that, the elastic is being stretched, and, people are trying to falsify the earnings in order to make their management bonuses, which you see a huge amount of. And the third test is looking at working capital ratios. And again, this is not necessarily a sign of a fraud per se, but if the company is resorting to earnings management, it usually shows up in the working capital.
So in terms of management red flags, I love your story about the chief executive of the Hut Group. That was often seen more often with his shirt off rather than his shirt on.
Well, I'm trying to. So this is a hilarious one. I'm going to be doing a course for one of the big banks here, and they have a unit that does lending. I maybe shouldn't say the detail of it, but I was talking about the Hut Group, and I said I'm going to put the Hut Group, the guy with his shirt off, but I'm trying to think of the right pun, because he has lost his shirt.
It's a great story. Any other good management stories or management red flags maybe you look out for and how they conduct their business, like qualitatively?
Yeah, there's a whole list of them, and it was actually Jim Chanos, who is a very, I don't know him, I've never met him, I've never had an email exchange or anything, but I discovered that I was having an exchange with him on Twitter. I hadn't realised it was him. And really lovely, because, there he is, like one of the giants of the hedge fund world, and a man who's been the longest serving short seller in the biggest bull market in history. And he survived and prospered. So, the guy's a genius, in my opinion. And he said he does a fraud course at Columbia. So he teaches people how to detect fraud. And he uses a book, I think it's called The 7 Signs of Ethical Collapse, or something like that. I could look it up. And, some of the tips, some of the signals are, chief executives who bully their staff. And, you've got young'uns and a big boss. And those sorts of cultures tend to be the cultures in which fraud or aggressive earnings management are more likely to occur.
So if you were to get on your soapbox, especially given the last year, how would you get people to care more about financial statements and caring about the numbers? Is that just a case of sometimes they have to get burnt, or because it's been a bit of buy now, think later, and
Well, funny enough, it's one of your countrymen who cancelled my course. So I have a course called the Analyst Academy. It's a 12-month subscription, and he'd been on it for about 6 months, and he cancelled. And whenever anybody cancels, I've got a very low cancellation rate because the course is exceptional and it's amazing value, I think. Obviously there's a limit. You get a limited amount of my time because I just do a webinar once every month or so. But the content is, really astonishing. And whenever anybody cancels, I always email them personally and say, can you tell me why you cancelled? Because if I can get feedback as to what I'm doing wrong, then I can change, the content. And this guy said, well, I don't know why I'm doing this. I should have just bought Tesla. And my immediate reaction was to throw up my hands in horror and say, oh God, this is so stupid. How can he say that? And I thought about it. Actually, he's quite right. Why would you do my course? You don't need to know about the balance sheet. You just need to know. It's like that guy. I've forgotten his name. Actually, I probably shouldn't say his name. So one of my Twitter pals was having a debate with him about the relative merits of Zoom versus his beaten up, crappy retailer that was trading at a discount to book. And this guy said, "Oh, you know what? I have a fantastic view on Zoom, and it's brilliant." And he he bet the guy, and he tried to bet the guy $5,000 or $10,000, and my Twitter friend, I think, was struggling with the quantum, because although he felt confident about the outcome, and quite reasonably so, because of course some random bloke on Twitter, you bet him, no guarantee he's going to pay up, right? And you might feel obliged to pay him. Anyway, this guy has a newsletter, and he has a lot, tens of thousands of followers on Twitter, a multiple of the number of followers I've got. And I sort of gently pitched into this conversation. I said, so what do you think of the valuation of Zoom? And you know what he said to me? He said, I don't look at valuations. I just think it'll be a bigger company in 5 years' time. And you know what? You're wasting your time even having a discussion with somebody whose view of stock market investing is predicated on the basis that it could be a bigger company in 5 years' time. Because the guy is an idiot, right? He is, beyond stupid. And it so happens that when you've got a massive, crazy bull market, that it's not the cleverest people that make the most money. It's the stupidest people who are prepared to take the most risk, who don't know what they're doing. And this guy is making a fortune because he's buying all this crap stock, and he's got all these idiots paying him to give him stock ideas. And when this bubble bursts, they're all going to lose their shirt. They're all going to be they're going to be photographed like Matt, I can't remember his name, the Hut Group guy, no shirt. And I hope they've spent as much time in the gym as he, and look as good as he does, because this particular fat American is going to look really stupid without his shirt. But, I can't tell you when or even if this will happen, because we're in such a strange time. And interest rates are so incredibly low that, this could carry on. In actual fact, at that point, I think Zoom was $170 billion. Now, I don't know what the capitalization of Zoom is today. Should really look.
Yeah, 75.
Yeah, so it's halved. So, this was very close to the peak in Zoom. I don't even know what the name of the retailer was, but I would bet money it's doubled. So there's been a 4 times tilt in favor. And at 75 billion, I would argue that Zoom's still expensive. Yeah, I've really shied away from giving recommendations, because what I'm trying to do, honestly, is to help people. And, what I'm trying to do is I'm trying to teach people how to fish rather than giving them a fish.
Do you find people pretty receptive to that, though? Or do you think people want to be given the fish more often than not?
No, people want to be given money. Give us a brilliant stock idea and let's make lots of money, and then give us another one. And, look, I've done that. I was a sell-side analyst for many years, and I'm not going to, if I wanted to, I would become an institutional research boutique. And service institutions, because in theory, at least, they should pay more than the retail market. If you've got a big enough scale, the retail market can work. If your marketing is effective enough, it can be a lucrative affair. But I don't really have any interest in doing that. I think I can add much more value to people by helping them improve their investing technique, and they can learn, and then they can find stocks and do it for forever, rather than, rely on me. I think that's a much more valuable service I'm doing, rather than telling them to buy Marks and Spencer, But, oddly, I shouldn't have done it, but I got sucked into the Tesla thing. So trying to resist the temptation, I just couldn't resist it any longer. After the conversation at the weekend, the tweet from Elon Musk about should I sell my stock? The guy's a genius, and the share price, people have made a huge amount of money, and I'm just sore because I didn't. But the stock's obviously massively overvalued. I mean, just ridiculously overvalued. And he's found a way of selling stock without it being his decision. I don't take a salary. Well, you've got 36% of his stock pledged as collateral. So, if you wanted to, you could borrow $10 billion tomorrow easily. But I think I'll probably look back on this as it being a mistake. But I am short of Tesla on the back of this. And I did a video just explaining why I thought the thing was ridiculous. And I started to look at Cathie Wood's valuation target. I mean, to say it's stupid, I mean, she hasn't even got the number of shares right. I mean, how could anybody have any credibility when they can't even get the right number of shares? I mean, I just don't even begin to understand. Honestly, I mean, it's just a travesty. And I should just add, look, I am short Tesla. It is not investment advice. I could be, while we're speaking, I could close that position. I mean, this is only a short-term trade. I don't do that much short-term trading, but I do a bit of it. But I do it because it's just a legacy of my professional days that sometimes something's just too tempting not to do. I'm doing a little bit of shorting now because I feel the market's at the stage where I can do that.
So probably with all the upheaval from COVID, do you think there's any examples of how forensic accounting can identify changes that are transitory versus those that are likely to be permanent?
I mean, quite interesting, the supply chain changes. So last April, I did a blog, the 10 changes that we should think about post the virus. And I kind of made that the last chapter in my book because I thought my book was published in November and I thought it's really, be quite odd to publish a book at this time and not mention COVID. Well, I just thought it would make it more relevant. I mean, I'm not sure that it was the right decision because obviously I'm hoping people in 5 years' time will buy the book and then it'll have this like weird chapter. But I suppose we can always just take it out. I mean, it won't change the book with or without. But the one of the things I talked about was supply chain. And I talked about, the amount of credit taken by large companies from smaller suppliers. And I said, well, in this environment, this may well have to unwind. And I talked about, reshoring, deglobalization or whatever. And, I said, this is not going to be an easy transition. And I mean, I hadn't envisaged that the problems that we're encountering would be quite as severe. But I was, thinking, well, I use the example of Electrolux, the appliance manufacturer. I don't know how many components there are in a fridge. 1,000, 10,000, I don't know. I mean, let's call it 3,000. But you only need to be missing one tiny washer or specialist, one specialist piece, and you can't ship. And that's what we're seeing, How transitory will that be? I don't know. I mean, I think certainly what it's contributing to is inflation. And that inflation will certainly not be transitory. I mean, all these people saying, it's inflation, it's just temporary, it's just going to, it's just because of the nonsense, in my view.
In terms of general accounting standards and rules, if you had a magic wand, what accounting standards would you change for listed companies? And what would you be going after? What needs to shake up? I've heard you speak about it before. Is IFRS 16 your first target? What really grinds your gears in accounting standards?
Oh, I mean, I don't know where I would start. I'd start with FRS 1 and then go through to 16. I mean, I go through every single one of them. The cash flow statement, I mean, it is pathetic. I don't know. I mean, I just don't think the accounting standard setters have got a clue. I mean, they just do not live in the real world. And the accountants, the auditors, don't live in the real world. I mean, 16 is garbage. I mean, if ever there was a problem a solution looking for a problem. It was IFRS 16. Funny, you know, my former colleague Matt Tilling, super nice guy, was doing my accounting training for some of my clients. But we found it very hard to sell institutional investors in the idea that they should know more about accounting. Surprisingly, I mean, you know, we did a lot of helping people when there was a problem, an issue. And the thing that I think is slightly bizarre, so I am an expert accountant, but I don't spend a huge amount of time looking at the new standards or worrying about them. I just, you know, when they come out, I look at the stuff and I say, okay, what does that mean? And sometimes the treatment today, and not necessarily that there's been a new standard, but there's a new way of doing, some of the stuff is so complicated that you know, the sensible answer, oh no, that's not right because of this. And you've actually got, I mean, it's as if you need legal advice. So you need to go and have professional accounting advice because the common sense answer doesn't work anymore. And it's just incredibly stupid. And this idea that you've got so many notional adjustments to make the accounts theoretically accurate. And IFRS 16 is a classic example of that. You know, no longer do you know what the operating lease rentals are. And I said to Matt, well, that's really stupid. He said, but there's no such thing as an operating lease rental. I said, Matt, hello? Every company that is leasing an office has an operating lease rental. It is a legal document. It is a legal obligation. What are you talking about? There's no such thing. The accountants say there's no such thing. There's no such thing. You've got these fictitious assets and these fictitious liabilities. Well, guess what? What I want to know is how much the company has to pay each year. And they've just obliterated that. I mean, if they wanted to put all this garbage nonsense on the balance sheet, fine. Put your theoretical calculations on the balance sheet, fine. But don't take away the basic information that I'm used to having that helps me. I mean, there's a number of instances where the rules have changed and they've deleted information that was actually really valuable. And then they add all these requirements to produce these theoretical calculations that are, you know, I mean, I struggle to know who gets a benefit from them. Probably the accounting profession and the auditors get, you know, the auditors can spend a huge amount of time and money checking that the calculations are accurate according to the standard. I mean, words fail me. They've tried to enlist my support. There's a group that's kind of like a user group. And they said, oh, well, Steve, why don't you join this user group? And I sort of went along to a couple of events and I listened to what they said. And I said, you know what? I just think it's a waste of time. I'm not going to. But, oh, well, you want to change things? You've got to, yeah. And I said, well, but the thing is that, you know, you've got all these big committees and they're dominated by accountants who have got a different agenda. I think I can do a better service by telling people, you know, these things are a complete waste of time. Just ignore it.
So what's their agenda? Do you think just pad the balance sheet and hide as much information as they can, or?
Well, I don't really, I don't honestly know. I mean, I struggle to understand why they think that you've got a retailer and putting a notional asset for the shops on the balance sheet and notional liability on the balance sheet is better than the old method. I mean, if you've got that, and you know, okay, so if it were me, you know, I might put that information together and I might add it as a note to the accounts. I mean, you know, if I wanted to, but to add a notional liability, and the calculation of that liability is incredibly subjective and not consistent from one company to another. At least with an operating lease rental, you know what the cash flow is going to be.
Yeah. And if you want to make an estimate of what the balance sheet effect will be, you can do it very easily. With this, I mean, I've got very little confidence that the assets and liabilities are consistent from one company to another.
So is it even possible to align the incentives of auditors, companies and shareholders, do you think? And is it even possible? And if so, how?
Companies should want what is right for their investors. They should. I mean, in some cases, you've got vested interests because the accounting department doesn't want to do stuff that's too difficult or too complicated. In some cases, you've got an issue because the management are worried that this will impinge on their ability to fleece the shareholders for stock options. But also, I think the investment industry have done a poor job in representing themselves to the people that are creating the accounts. So they've not been nearly vocal enough, and they don't organise themselves together because they're all competing. But in actual fact, what they should do is they should create a pressure group, and they should appoint somebody like me and to come up with some so okay, adjusted earnings, here's what you're allowed to do with adjusted earnings. I mean, the SEC should do this. It should say, okay, if you're going to have adjusted earnings, they have to conform to this. The accountants are too stupid to make up some sensible rules, so we'll make them up. And then if you don't conform to that, you'll get a fine. And not only will the company get fined, but the CEO and CFO will get fined personally. And then everybody would obey the rules. But you've got the ridiculous situation today that Warren Buffett is producing a non-GAAP measure. I mean, whoever is in charge of GAAP should go and jump out the window when Warren Buffett has to produce an alternative performance measure. Words fail me, I mean, if they can't see that they've lost their way from that, how would they ever see?
What's been some of the worst accounting offences you've come across in your entire career? Like, are there any examples that stick out or come to mind straight away?
Well, I mean, any of the big frauds, from Enron to Patisserie Valerie, Steinhoff, there is an amazing number of frauds. The accounting, people doing accounting tricks, well, I think in my forensic accounting course, I've got something like between 150 and 200 different examples of companies cheating. And some of them are shocking, really quite shocking. And some of them are less severe. But in all of these cases, the companies are deliberately trying to pull the wool over investors' eyes. And, I think it's the responsibility of people like me to shine a light on that sort of trickery and ensure that people understand how to spot it.
No, fair enough. So maybe I'd like to hear about your podcast and what you do, because what was your motivations for starting the podcast and even behind the balance sheet? So moving away from a corporate career, like why make the leap and do your own thing? And because I suppose it's pretty uncertain waters, I guess.
I set up my own business because no hedge fund wants to employ me. I couldn't even get an interview. So the fund that I was working for, we'd made the decision that it would close at the end of the year. None of us, I was taking a draw, but the original founders weren't making any money, and we'd tried to grow the assets under management unsuccessfully. The performance wasn't brilliant, and we were subscale, and I'd been brought in to take it upscale. But as soon as I joined, the fund fell 5%, and then the founders were reluctant to take on risk, and then of course you don't take risk, you can't make money. So the founder called me into the office and said, "Look, I'm going to give it to the end of the year, but if we don't grow, I think we're going to close." And I thought, well, I better get out because I'm a partner and we've just signed a long lease on a very expensive office in the flashiest part of the West End, most expensive street, you know. It wasn't an expensive office by the local standards, but it was an expensive office, and I didn't want to pay my share of 10 years of that rent. Yeah. So I thought, well, look, I don't think there's any chance of us making any money or getting any more funds under management, so I'm going to go and get another job. But, you know, I couldn't go to headhunters. I couldn't let the word out. So I just applied for jobs that I saw advertised, mainly on LinkedIn. And I applied for 47 jobs on LinkedIn. And I got one reply. The only reply I got was from a fund who were serviced by a sales guy that I was friendly with, who I'd called up and said, I've applied for this job, tell them to see me. And they replied saying, I'm sorry, I don't think you're a good fit, we don't want to see you. And I just thought, well, you know, why is this? Because you could argue about my ability, but, you know, I've got a pretty decent track record. I've got a pretty decent CV, and I'd add quite a lot of value to most funds. And I came to the conclusion that it was age. People did not want to employ an analyst who was over 50. Because the average hedge fund manager in London is something like 42. And they don't want somebody older than them. That was, I mean, that's my hypothesis. I mean, I don't know whether it's possible to prove it. But and I thought, okay, well, look, you've got various options. And one of the options was to take my experience and you know, deploy that to my advantage, and hence the training business. And I quite like teaching people, and I can do fun stuff that I wouldn't otherwise be able to do. The podcast came about because various people had said to me, why don't you do a podcast? And I thought, well, you know, should I? Anyway, I've since I set up my business, I've set myself a new challenge each year, or at least one. And I thought the podcast would be a new challenge. And originally, I was going to do it last year. And Pete Davis, the then senior partner of Lansdowne Partners, which is, you know, one of the largest, most successful, well, no longer one of the largest, had been one of the most successful hedge funds in London, said he would do the podcast. Now, I've known Pete for 20 years, and, you know, one of the advantages I've got is I've got a great Rolodex. But what I'm trying to do with the podcast, I'm trying to do a couple of things. The first thing is I'm trying to pass on my knowledge and learning by getting friends and contacts to pass on their knowledge and learning. And, you know, I think that this is a worthwhile endeavor, helping people to improve their investing skills. And that's the purpose of the podcast, is to educate people. Obviously, we also hope to entertain them, but, you know. The second objective is a much higher objective. About a year ago, I read in the FT Weekend magazine an article by Patrick Jenkins, the deputy editor. And he said that FT was going to set up a financial literacy campaign. And I wrote to him and I said, that's fantastic. I said, because in my plan, I'm not a great, you know, I don't have a strategic plan, but one of the things I said that I would do in my, you know, new thing. So my new thing for 2023 was I was going to set up a financial literacy charity in the second half of this year. And I said, oh, well, that's great, because you are going to do a much better job of it than I ever would. And the issue here is that kids do not get taught in school about money. It's crazy, right? So I was walking across Hyde Park in London, central London, going to lunch with my elder son, who goes to one of the best schools in London, England, and probably the world. I mean, it is an unbelievable school. I mean, you know, I wish that I had gone to school like that. And, you know, of the day schools in the UK, it's undoubtedly one of the top ones. And I said to him, so what do you get taught about money at school? Nothing. So, oh, well, I better teach you then, hadn't I? But if you think about life, what do you need in life? You need love and money, which was the name of a Scottish Glaswegian band. And
everybody needs love, and you can be lucky in love or unlucky in love, but there's not, there are some things you can do to make yourself a more attractive person, but you've got to be lucky as well to find the right person, and you can think you found the right person, and the person can change over time. I'm not an expert in that. I feel I have a little bit more expertise in the money side. And I just think, why you don't need a lot of money to be happy. And in fact, the more money you have, often the less happy you are. But you need a bare minimum to get by. And people who don't have enough money tend to have a more miserable life, but that's not actually true. I mean, lots of people with not enough money are very happy, but their life is more difficult than it otherwise need be. And it's those people that usually suffer the most from the scammers. Payday loans, borrowing in your credit cards, not saving early, so having a miserable retirement because their kids don't care about them. And you think, well, these things are incredibly simple problems to solve. I was talking to Patrick about it, and Patrick's a really nice guy, and I said to him, I'm going to do whatever I can to help this charity, because to me, this is a classic example of Warren Buffett's 1 foot bar. There's some amazing charities that are out there to solve incredibly difficult problems, to find a cure for cancer. The charity that I've hitherto supported as my primary charity is a charity called Duchenne. And my elder boy, one of the kids in his school, when he was very young, one of the mums emailed all the parents. And I remember very vividly, I was in my kitchen on the bar stool at the end of the bar, having a glass of wine on a Friday evening. I was just going through my emails, talking to my wife. And I opened this email, and Emily Crossley, lovely lady, talked about her son Eli and how he would soon find it difficult to get up the stairs at school, and then he would be in a wheelchair because he had this Duchenne's disease, and there wasn't a cure for it. And I actually started crying reading an email. I've never cried reading an email, but I thought, you know what, that could be my kid. It's only luck that separates me from her, And I said, Emily, I'm going to do everything I can to help you. And, that is a fantastic cause. And she's raised a huge amount of money. They're doing clinical trials of various drugs, but she may or may not be successful. It's an absolutely fantastic cause, and I'm continuing to support it wholeheartedly. But the financial literacy and inclusion campaign, and if your listeners can find it, ft.com/FLIC. This is a 1 foot bar, because we can teach every child in the world about compound interest. We can explain to every child in the world, if you save for your future early, compound interest will help you. We can explain to them that borrowing on your credit cards is a bad idea. Payday loans is a bad idea. Okay, you may need the money. You may have a burning need for it, and that's the only resort. But try and pay it off as fast as you can. Those simple lessons can help a lot of people. How many people, I don't know, but potentially millions of people. So this charity is starting in the UK, and they're starting to educate kids in school. And Patrick says one of the problems is that teachers don't feel comfortable about money. So it's part of the curriculum, but it's not a compulsory part of the curriculum. It's an optional part of the curriculum, but the teachers don't feel comfortable about teaching it because they don't understand it themselves, right? So, one of the programs is to train the teachers. But, to me, this is straightforward, and this is a potentially, it's like a tiny thing, but potentially, could be life-changing for many, many people. So, that is a primary motivation for me to do the podcast, because there is a very good way of getting that message out. And in our second podcast with the brilliant Stuart Roden,
I tacked an interview with Patrick on the end of that, and we'll release that as a separate show. It's only a 15-minute episode, but just me talking to Patrick about, well, what is the charity, why, what are you going to do? And, you know, I'm in the fortunate position that I now have, you know, some people listening to me, and I can do a lot of good by advertising that charity to a lot of, you know, ordinary people, but also trying to motivate some of my friends who have been incredibly successful, you know, running hedge funds, and they're very, very wealthy, and some of them are very philanthropic. And, you know, I know more than one person with a foundation of over £100 million. And, you know, if we can persuade them, you know, I can say, look, I think this is a 1 foot bar, I think we can do a lot of good, and you just get a little bit of money, I can help. And also the other thing is it's quite good fun, you know. I mean, interestingly, the videos, I mean, the quality of the videos isn't brilliant, but I did go through a phase where I hired a studio and hired a man to video me, and did a whole rack of them off the top. Yeah. But I'm now just doing them at my desk when it's for fun. Something appeals to me, and you know they're good fun to do. The podcast I've found to be interesting in a different way, because like particularly I was the one with Stuart. I learned. I mean, all 5 of the podcasts that I've recorded to date, and 3 of them have been published, I've learned a huge amount. But I've never had a conversation like that with Stuart. And that's what, so unless I had a podcast, I would never have learned those things. Because, I mean, I might sit down and have a cup of coffee with him, but, we'd be sitting having a cup of coffee. It wouldn't say, well, Stuart, what makes a good investor? And he then, said, well, there are 4 things. And he'd thought about it. I mean, the thing that amazed me was, I didn't tell him, I'm going to ask you this, and you can prepare an answer. I just said, off the cuff. And he had clearly given it a tremendous amount of thought, because he was trying to improve his own performance. And that really impressed me, because he's a seriously good investor. But in spite of his fantastic skill, he was hungry to do even better.
I love that answer. I think that's probably a great way to wrap up, because I know you're a busy man, so I appreciate you being on today, Steve. So.
Well, no, I mean, listen, thank you for asking me. I hope it helps with you promote the podcast and attract some more listeners. I always happy to help anybody. I've got a lot of friends in Australia. As I said to you, this lunchtime I'm doing a presentation to the Australian CPA Society, the accountants in the EMEA region. I've been doing their lunchtime webinar for the last 12 months. I've done several of them. Really nice group of people to work with. And I've got a long-standing connection to Australia. I've got a lot of friends there. I visited for the first time many, many years ago. I mean, I was really quite young. I went there the first time, and I've been going there. I mean, I now have teenage children, but when you get young children, that is too long a distance. But we used to holiday at Christmas time in your part of the world, and I'm looking forward to going back. I've got lots of connections in Australia, and Australia is one of my top markets. I mean, it's not, it's obviously it's a small market, but I think I must have quite a high share of that market in terms of, the book is sold very well. So if you haven't bought the book, you really should. It's called The Smart Money Method, How to Invest Like a Hedge Fund Pro. Available on Amazon and all good other booksellers. It isn't actually available on other good booksellers, because the booksellers in the UK don't stock it. But I've also got quite a lot of
Australians on my Analyst Academy course. So you want to find the courses, visit my website, behindthebalancesheet.com. And please, I hope lots of your listeners sign up for my newsletter. I've been rather disappointed in the circulation of the newsletter. I produce some really interesting content. So not just blogs, but I do book reviews, podcast reviews. And if you sign up, you get access to my club site, which is like separate from the main website behind a paywall. It's not a paywall, it's free. You just need to sign up and get your email so that we can enroll you. And there's, I don't know how many, we've got hundreds of fund letters. We've got a library with 1,500 investing articles. It's an absolutely amazing resource. I don't know why people don't use it more. I probably do a very poor job of advertising it. And if you want to find me, you can follow me on Twitter at Steve Clapham.
If you enjoyed this podcast episode, be sure to check out the website compoundingpodcast.com. On the website, you'll find every episode complete with transcripts, show notes, and other related resources. If you want an email notification every time an episode releases, plus my lessons and takeaways from each episode, be sure to sign up to the Substack. So that's compoundingcuriosity.substack.com. Either way, links to all content mentioned today will be in the description below, and you can also connect with me on Twitter at ScarrettKalani. But until next time, have a good one.